If you bought your home in the last few years when interest rates were higher, there's a good chance you thought about refinancing. Maybe you've heard that rates have dropped and you're wondering if now is the right time to make the move. Or maybe you're not even sure what refinancing really means or whether it applies to your situation. Today, we're breaking all of it down. My name is Robert Portal and I'm a home loan advisor. My team and I have helped hundreds of families across the nation navigate the home buying process while making it stress-free. By the end of this video, you're gonna know exactly what refinancing is, different types, how to calculate whether it actually makes financial sense for you, and the key questions to ask before you pull the trigger. This is one of the most powerful tools available to homeowners, and most people don't fully understand how to use it. Let's get into it. What is refinancing? Let's start with the basics. Refinance your mortgage means replacing your existing home loan with a brand new one, ideally with better terms. When you refinance, your new lender pays off your old mortgage and you start fresh with a new loan, a new interest rate, and a new monthly payment. Think of it like trading in your old loan for a better one. Now, refinancing isn't free. There are closing costs involved, just like when you originally bought the home. We'll talk about how to factor those in when decided whether it makes sense. But the potential savings over the life of the loan can be significant, sometimes tens of thousands of dollars, which is why it's worth understanding it thoroughly. There are two main types of refinances, and they serve very different purposes. The first is a rate and term refinance. You're simply changing your interest rate, your loan term, or both without taking any cash out. The second is a cash out refinance where you borrow more than you owe on your current mortgage and receive the difference in cash, which you can use for home improvements, paying off debt, or other financial goals. For first-time homeowners thinking about refinancing for the first time, a rate and term refinance is the most common starting, and that's what we're going to focus on primarily in this video. Sign one, your interest rate is meaningfully higher than current rates. The most obvious reason to refinance is to get a lower interest rate. But how much lower does the rate need to be to make it worth it? You probably heard the old rule of thumb that says you should only refinance if you can drop your rate by at least 1%. Now, that's not a bad starting point, but it's not the whole picture. Whether a rate drop makes sense depends on your specific loan balance, your closing costs, and how long you plan to stay on the home. Here's a simple way to think about it. On a $400,000 home, dropping your rate from 7% to 6% saves you roughly $270 per month. Over a year, that's about $3,200, and over 5 years, that's about $16,000. That's a meaningful number, and it's why even a 0.5% drop can be worth pursuing on a larger loan balance. The key is to run your own numbers rather than relying on a blanket rule. Your loan officer can pull up side-by-side comparison showing your current payment versus a new payment and exactly how long it'll take for savings to outweigh the cost of refinancing. Sign two, you can calculate a clear break-even point. This is the single most important concept in the refinancing decision, and most homeowners have never even heard of it. Your break-even point is the number of months it takes for your monthly savings to cover the cost of refinancing. Here's how to calculate it. Take the total closing cost of the refinance and divide it by your monthly savings. That gives you the number of months until you break even. For example, if your refinance costs $6,000 in closing costs and you're saving $300 per month, your break-even point is 20 months. That means if you stay in the home for at least 20 months after refinancing, you come out ahead. Every month after that is pure savings. Now, if you plan to sell the home before you hit your break-even point, refinancing probably doesn't make financial sense. You'd spend more on closing costs than you'd save on payments. This is why the break-even calculation is so important. It takes all of the guesswork out of your decision and it gives you a clear, objective answer based on your specific numbers. Sign three, your credit score has improved since you bought. Here's one that a lot of homeowners overlook. If your credit score was lower when you originally got your mortgage, maybe you were just starting to build credit or you had some issues since you've resolved, you may have been given a higher interest rate. Even if market rates haven't changed dramatically, a significant improvement in your credit score could qualify you for a meaningfully better rate today. For example, if you buy your home with a credit score of 640 and you've since built it up to 760, you may not qualify for a rate that's 0.5% to a full percent lower, purely based on your improved credit worthiness. Before you assume refinancing isn't worth it because rates haven't dropped enough, check your current credit score and compare it to where it was when you first got your loan. If there's been meaningful improvement, it's worth getting a refinance quote just to see what rate you'd qualify for today. Sign 4, you want to change your loan term. Refinancing isn't just about lowering your rate. Sometimes it's about restructuring the timeline of your loan. There are two directions you can go here. Some homeowners refinance from a 30-year mortgage into a 15-year mortgage. Your monthly payment will be higher, but you'll pay off the home significantly faster and save enormous amount of interest over the life of the loan. On a $400,000 loan, the difference in total interest paid between a 30-year and a 15-year loan can be well over $100,000. Other homeowners go the opposite direction, refinancing from a 15-year into a 30-year to lower their monthly payment and free up cash flow. Maybe your financial situation has changed. Maybe you want to redirect money towards other investments. Or maybe you just need breathing room in your budget. Neither option is automatically better. It depends entirely on your financial goals and your current situation. But the point is that refinancing gives you the flexibility to restructure your loan to match where you are in life right now, not where you were when you originally bought. Quick pause. If this is helping you think through one of the biggest financial decisions you'll make as a homeowner, go ahead and hit that subscribe button. We post videos every week breaking down homeownership topics in plain English, specifically for first time buyers and new homeowners. No jargon, no fluff. All right, let's keep it going. Sign 5, you want to eliminate PMI. If you buy your home with less than 20% down, you're likely paying what's called private mortgage insurance, or PMI, every month. PMI protects the lender, not you, and it adds anywhere from $50 to several $100 to your monthly payment, depending on your loan balance. The good news is that PMI doesn't have to be permanent. If your home has appreciated in value since you bought it, which is likely if you own it for a few years in most markets, you may not have 20% or more equity in the home. A refinance with a new appraisal could eliminate your PMI entirely, reducing your monthly payment even if your interest rate stays roughly the same. For example, if you're paying $150 a month in PMI and you refinance into a loan where you now have 20% equity, that $150 per month disappears. That's $1,800 a year back in your pocket just from getting rid of PMI. So talk to your lender about what your home might appraise for today. If the math works, eliminating PMI alone can be a compelling reason to refinance. Sign 6, you understand the full cost of refinancing. Before you move forward with a refinance, you need to go in with eyes open about what's it going to cost you. Refinancing has closing costs just like your original mortgage. These typically run between 2% and 5% of the loan amount. So on a $400,000 loan, that's $8,000 to $12,000 in closing costs. That's not a small number, and it has to be factored in your break-even calculation. Some lenders offer what's called a no closing cost refinance, but don't let that name fool you. These costs don't disappear. They're either rolled into your loan balance, which means you're paying interest on them over time, or they're built into a slightly higher interest rate. It's not inherently a bad option, but make sure you understand the trade-off. Ask your lender to show you a full loan estimate, just like when you bought, so you can see every cost line by line. Then run your break-even calculation with those real numbers before you decide. Sign 7, you shop more than one lender. Refinance rates and fees vary from lender to lender, sometimes significantly. So getting quotes from 2 or 3 lenders takes an extra day, but it could save you thousands of dollars either in a lower rate, lower closing costs, or both. Your current lender is a natural starting point since they already have your loan information. But don't assume loyalty gets you the best deal. Online lenders, credit unions, and mortgage brokers are all worth contacting for comparison quotes. And just like when you were shopping for a purchase mortgage, multiple refinance inquiries within a focused 14 to 45-day window are treated as a single inquiry for credit scoring purposes. So, shopping around does not hurt your credit. There's no reason to compare. Recap and next steps. Let's bring it all together. Here are the signs that it may be a good time to refinance. 1, your current interest rate is meaningfully higher than what you could qualify for today. 2, you've calculated your break-even point and you plan to stay in the home long enough to come out ahead. 3, your credit score has improved significantly since you originally got your mortgage. 4, you want to restructure your loan term, either to pay it off faster or to lower your monthly payment. 5, you have enough equity to eliminate PMI, which could save you hundreds per year on its own. 6, you understand the full closing costs and have factored them into your decision. 7, you've shopped at least 2 or 3 lenders to make sure you're getting the best rate and terms available. Refinancing at the right time can save you tens of thousands of dollars over the life of your loan. But it's not a decision to make based on hunch or because a friend told you that rates dropped. Run your numbers, know your break even point, and make the decision based on your specific situation. Drop a comment below. Are you currently thinking about refinancing, or are you trying to figure out if the timing is right? I read every comment and I'm happy to help point you in the right direction. And if you haven't subscribed yet, we post every week to help first time buyers and new homeowners make confident financial decisions. See you in the next one.